Welcome back everybody to the Economic Analyst's channel. In this video, I'm going to do something a little bit different. Back in late May, I wrote down a proposal to actually shore up the U.S. currency because back then I was seeing that the price inflation was starting to rise. And I was worried that over time it may jeopardize the stability of our economy as well as our currency and lead to rampant inflation. Not necessarily leading to, say, hyperinflation, but it could have been a possibility depending on how extreme monetary and fiscal policy went under the current administration. So as proof in the pudding, I want you to take note of this document and the last date modified. The last date modified was June 27th, 2021. And really, that was just a couple of spelling corrections. That was no kind of adjustment to the actual writing of the document. The date of this document actually is about late May. I pretty much dated it at June 1st on the document itself. But even if you were to take this latest date right here, this comes back to late June. And I wanted to read this proposal to you because I wanted to gauge just and show you just how accurate this was. Not to give any kind of credit to me, but just to show you that the things that I'm talking about, they're coming to pass, and it's indicative of the reality that is setting into our market structure right now. So without further ado, let me open up this document. It's called the Proposal to Save the U.S. Dollar. I shared this with a few people and wanted them to spread it, but I doubt that you've ever seen this document before. So, here we go. The proposal to save the U.S. dollar. Our dollar as a stable currency is in jeopardy. Recent expansionary policies by our monetary and fiscal authorities combined with pandemic shutdowns have caused a surge in rising commodity prices, which are starting to translate into higher retail prices for the American consumer. Some of this inflation can be attributed to supply shortages of certain raw materials and manufactured goods caused by government-mandated shutdowns. And as world economies open up, these shortages will slowly fade away. However, the real threat is the persistent price inflation that is monetary and fiscal in nature, which I'm about to lay out. The Federal Reserve has printed an unprecedented amount of money in the last year. Since December of 2019, M2, a broad measure of the U.S. money supply, has increased from $15 trillion to $20 trillion, or 33%. Total U.S. debt has increased from $76 trillion to $86 trillion, or 14% at the same time. Comparing the increases in M2 and debt to the CPI in the past have yielded a remarkably stable correlation by decade, as Figure 1 below illustrates. For the last 20 years, a 100% increase in M2 and debt has led to a 30% increase in the CPI. At the rate the Fed is pumping money and increasing debt currently, we are looking at a 6% average annual CPI inflation rate for as long as the Fed continues down this course. And that's if confidence in the dollar remains high. If confidence in the currency falls, as it did in the 1970s, evidenced by higher consumer prices from surging goods demand, then the inflation rate could increase to double digits. And in the actual chart, I actually showing it getting up to as high as 16% in 1 year, and over the course of 10 years at that rate, 12% price inflation. Very similar to what is going on right now at the end of November. This is unsustainable. With record low interest rates, these higher inflation numbers will cause real losses on any debt securities that are paying lower than the inflation rate. Investors and debt owners will not tolerate negative returns on their holdings. They will eventually sell these securities, which will raise those interest rates and force higher interest payments on any new debt issuance. Figure 2 shows that the U.S. total debt to GDP has increased 250% in the past 40 years, meaning that any increase in interest rates will have a much more negative impact to the economy now than in the previous inflation cycle. With respect to the aggregate economy, U.S. government treasuries are at record low interest rates, and if these rates are forced up by the coming bond sell-off, that will force up interest payments the U.S. government has to make on new debt, which will increase the deficit already beyond its current record level. Given enough time of higher and higher deficits, investors and debt holders will begin to suspect that the U.S. may not be able to pay back the debt with existing fiscal policies. This will lead to substantially higher taxes on our workers, entrepreneurs, and businesses, and reduced benefits for our elderly, disabled, and poor people in the near future, or result in a total collapse of the U.S. currency, leading to mass poverty, starvation, and homelessness. The record deficits under the Biden administration, along with the accumulated debts from the past 3 administrations, have compounded this problem. Government spending has reached such catastrophically high levels that private sector GDP contracted in Q1 2021, according to Figure 3. Excess stimulus spending designed to boost the private sector economy has done the exact opposite and instead has crowded out private sector spending and investment. The private sector of the economy is integral to government financing. This will undoubtedly lead to increased deficits over time. Increasing debt and rising payments will blow these deficits up even further and provide even more pessimism on the U.S. dollar, prompting more sell-offs in the bond market and could feed back into a vicious cycle of ever-increasing interest rates along with goods price inflation. The false notion that government stimulus and spending grows the economy needs to be countered in economic and political circles immediately. These policies are destructive because they erode capital formation over time and discourage business investment, which is the core of all economic productivity. It is the total savings of an economy that actually incentivizes business investment as resources reallocate from consuming products to investing in producing products. Figure 4 depicts a strong correlation between net private investment and net savings over time. Consequently, a reduction in government deficits, driven primarily by a reduction in government spending, will increase net savings in the economy and lead to higher economic growth over time. Most importantly, this will help stabilize the dollar because it will lead to less debt increases over time. Any debt increases that do materialize will be private sector in nature, leading to increased economic growth, and backed more by savings rather than inflationary government spending that squanders resources. To stabilize and save the U.S. dollar, the following measures will need to be implemented by our federal authorities immediately. Number 1, a cessation of all monetary stimulus measures and a relinquishing of the control of interest rates by the Federal Reserve. Existing U.S. Treasuries and other types of debt already purchased by the Fed can be kept on the balance sheet and rolled off as the debt expires to help avoid any complications with liquidity shortages in the private sector. Number 2, a cessation of all fiscal stimulus measures and a return to a pre-COVID baseline of federal spending, which is approximately $4.4 trillion annually if we use the 2019 federal spending level. Then, number 3, drastic reductions in the pre-COVID baseline of federal spending to balance the budget and restore confidence in U.S. Treasuries as a safe haven investment, lowering interest rates on these securities. Over time, increases in economic growth will yield higher revenues and thus budget surpluses, which can be used to pay down the debt in a sustainable manner. Before COVID, the government deficit was approximately $1 trillion. This deficit will need to be eliminated as soon as possible to stabilize the U.S. dollar. Government spending pre-COVID was approximately $4.4 trillion, including interest spent on the debt, according to the CBO. Federal revenues totaled $3.5 trillion during that same time period. The breakdown of federal spending in 2019 is as follows. Social Security, $1 trillion. Medicare, $650 billion. Other medical payments, $100 billion. Medicaid, CHIP, and ACA subsidies, which is Obamacare, $450 billion. Welfare income payments, $350 billion. Defense spending, $600 billion. Overseas contingency operations, $100 billion. Veterans benefits, $200 billion. Foreign aid, $50 billion. Healthcare research and development, $50 billion. Education, $150 billion. Police and prisons, $50 billion. Transportation, $100 billion. Courts, legislative, general government, $50 billion. Agriculture, forestry, fishing, and hunting, $50 billion. Research and economic bureaus, $50 billion. Interest payments on the debt, totaling $400 billion. To tackle this problem, federal reductions can be placed into 2 categories. Number 1, Programs that are relatively non-important and should be cut. Number 2, programs that are relatively important and can be turned over to the state governments to administer as they see fit. The thinking here in number 2 is that, yes, we might cut out of the federal budget, but it can be compensated by increasing in the state budgets in accordance with their people's will, which more reflects the people's desire state to state. Now, approximately $400 billion of spending can be eliminated completely in Category 1. $50 billion from ACA subsidies, $100 billion from the Overseas Contingency Fund that supports foreign wars, $50 billion from foreign aid to other countries, $50 billion from healthcare R&D, since there is a robust private sector healthcare industry that already does that, and $50 billion from other medical payments that include refundable tax credits along with other miscellaneous items. And while defense spending is a vital element of federal government, shutting down foreign bases and eliminating waste, fraud, and abuse out of the department can easily cut another $100 billion. In addition, a staggering $1.1 trillion of spending programs can be transferred over to the state governments for them to administer as they see fit in accordance with the public will. $50 billion from agriculture, forestry, fishing, and hunting, $50 billion from police and prisons, $100 billion from transportation, $150 billion from education, and then $750 billion from welfare, Medicaid, and CHIP. Most states have balanced budget requirements in their fiscal policies so that they will be less likely to run budget deficits with these programs on their finances versus the federal government. With $1 trillion in deficits and $1.5 trillion in proposed federal spending reductions, policymakers have choices in what programs to eliminate and what to keep on the federal level. Alternatively, a combination of tax increases and spending cuts can accomplish the same purpose. However, it is the reductions in government spending that will yield stronger economic output in future years, which will augment sustainable budget surpluses and contain price inflation. Therefore, a priority must be made to reducing government spending as much as possible over tax hikes to cover the deficit. The likelihood that Congress and the President will implement these corrective measures are non-existent. More than likely, they will continue with the current policies either out of willful ignorance or outright refusal of the political consequences, since most of these measures will be politically unpopular. The public will either have to pay higher state taxes or federal taxes for these programs, or they will be eliminated altogether. Even more disturbing, the remedies that politicians potentially conjure up will make the problem worse as they dismiss the core problems that are causing rampant price inflation. Therefore, I have laid out my outlook of how things will transpire in the coming years. First will come an eerie parallel to the 1970s with the buildup in price inflation. 4 to 5 to 6% year-over-year inflation will arrive, and investors will start to panic by dumping stocks and bonds. A stock market sell-off will ensue, though how much is unknown, and bond interest rates will steadily creep up on the longer end of the bond spectrum. Figure 5 depicts how the stock market performed in the 1970s under high inflation and interest rates. The Powell and the Biden administrations will insist that their policies were necessary to recover the economy from the COVID pandemic and government shutdowns in the past year. President Biden, along with the democratically controlled Congress, will initiate price controls, blaming greedy businesses for the increased prices, and shortages will develop in fuel and certain food products. The Republicans will pin the blame on Biden and his stimulus bills, painting him as the next Jimmy Carter. They will win the House and Senate in the fall of 2022, mostly because of this narrative. At best, they will halt further increases in government spending and remove the price controls. They may even prescribe mild reductions in government spending. However, these reductions will be made on the already grotesquely high levels of government spending now that amount to $6 to $7 trillion annually, and not on the pre-COVID federal baseline that I used to prescribe my spending cuts. The economy will fall into recession at some point in 2023 or 2024 due to a massive credit bubble burst brought on by higher interest rates, either delivered by higher inflationary pressures or excessively tight monetary policy used to counter those inflationary pressures. The stock market will crumble at this point, catastrophically falling from record overvaluations. Figure 6 shows that up until 1995, when the stock market started experiencing massive bubbles, the aggregate market capitalization corresponded with private sector GDP. The implication there in Figure 6 is that with the current levels of the stock market, it looks like there may be a crumbling of the stock market price indices by as much as 75%. The ultimate result will be a combination of the 1930s and the 1970s, an inflationary depression of sluggish economic growth and chronically high price increases. At that point, it remains unclear whether the United States will recover at all. I fear that foreign central banks and investors, who currently own $4 trillion of federal debt around the world, will sell those bonds and seek safer haven assets as U.S. treasuries will be constantly diminishing in value. The logical conclusion is that the U.S. dollar status as the world reserve currency will be called into question, possibly replaced by another currency such as the euro or gold, the historical reserve asset of choice, and further exacerbate inflationary forces at home. Dollars from abroad will come to the U.S. shores looking for something to spend on, and prices will increase yet further. We could very well be looking at a hyperinflationary scenario in the coming years, a demise of the U.S. as the world superpower, and a condemnation of the American people to a generation of poverty and suffering that they have never experienced before. I do not wish for these things, which is why I've written this proposal to save our way of life. Given today's current environment of economic ignorance and political divisiveness, I expect this proposal and its warning of future consequences to fall on deaf ears. I pray that I'm wrong. Sincerely, Gordon Oswald Dayton, June 1st, 2021. And that name right there, Gordon Oswald Dayton, is an alias. Guys, I thank you for watching this video. I will be publishing more content in the coming weeks. For the next week and a half, though, my schedule is very busy, so videos will be sparse on this channel. But once I am actually moving into a new home, once I get set up into the new home around early to mid-December, then I'll be able to produce content at the normal rate again. Once again, guys, I thank you for watching this. If you like the channel, make sure you click the like button. If you like the video, always click that like button on there. Subscribe to my channel. That way you're always up to date with the latest and greatest that I produce. And if you want to, click that notification bell so you are immediately notified anytime I upload a new video. Guys, I'll talk to you next time.